Hello, and welcome to today's KraneShares webinar, Back to Business for China and 2023 Outlook. My name is Brendan Ahern. I'm the Chief Investment Officer here at KraneShares Exchange Traded Funds. I'm joined today by Dr. Xiaolin Chen, our London-based Head of International. Earlier today, we published our 2023 China Outlook piece titled Leaping Back to Growth Potential in the Year of the Rabbit. I highly recommend investors take a look at this research piece. My colleagues and I, as well as our full team, put a lot of effort into this piece. Certainly my colleagues, Anthony, Henry, and Derek, Xiaolin, and others. I highly recommend reading this piece, and today's webinar will be a bit of a synopsis of the deeper dive that we take in the Outlook piece. If you haven't received the Outlook piece, please email us at info@kraneshares.com or contact your client service member as part of our team. Please proactively ask questions during the webinar as we hope for a lively question and answer post-presentation. If you're viewing on kraneshares.com, please email us at info@kraneshares.com. If you're joining us today on Zoom, questions can be asked via the question and answer tab button. And if you're joining us on Bright Talk, you can join us. You can submit questions via the questions tab. For those interested in receiving continuing education credits for your CFP, CIMA, or CPD accreditations, please email us at ce@kraneshares.com. So let's hop to it. I'll provide a quick synopsis of background on KraneShares, and then we'll dive into the thick of the presentation. So for those of you less acquainted with KraneShares, our founder, Jonathan Crane, formed two core beliefs during his experience living and building a successful business in China. Those two beliefs were the basis for founding of KraneShares almost 10 years ago. First, while new China sectors such as domestic consumption, internet, e-commerce, 5G, semiconductor, clean energy, and healthcare have become the new drivers of China's economic growth, these sectors are still underallocated and underrepresented in both global portfolios and global indices. Second, the opening of China's mainland equity market, the second largest in the world, as well as China's fixed income market, also the second largest in the world, will have a significant effect on investors' portfolios in the years to come, as those underlying mainland markets are included in global indices. Most importantly, we endeavor to earn the trust of investors through our balanced perspective on China's economy and capital markets. China's rise in market indices, along with its growing economy, will necessitate investors have a partner to navigate these developments. KraneShares wants to earn that partnership role with you. We maintain a daily research blog that is available at www.chinalastnight.com, which we encourage you to subscribe to as events move in China rapidly. Again, please proactively submit questions, whether you're joining us on KraneShares.com, Bright Talk, or Zoom. Now, many of you are very familiar with the suite of exchange-traded funds that we provide. That includes core holdings, as well as our thematic series. Many of the trends that we see in China, we've applied to global and emerging market, as well as we've developed a suite of climate-aligned exchange-traded funds, most notably our global carbon ETF, KRBN, which we've also expanded most notably with our KMET, our electric metals strategy. And just today, we launched CLIP, KLIP, a call writing strategy off of KraneShares for investors here in the United States. Now, Now, again, being at the year of the rabbit, let's hop right into it, Xiaolin. I know 2022 is in the rear view mirror, but let's take a look at what happened in the year past, and we can look at our outlook for 2023.
Thank you, Brandon, and good morning, good afternoon to all of you who joined us today. Thank you for your time in advance. When Brandon and I are preparing, say, we want to go through certain insights in our review where we see China market assessing today. It's also a time to reflect back in 2022. I think I have to admit this is, despite Brandon and ours and many of my colleagues, we look at China day in and day out. We recognize, and all the audience who join us and follow us on a very close and frequent basis, is China capital markets has gone through a very serious of a consolidation. It's either domestic regulation, external factors of ADR delisting, geopolitical issues, domestic policy on COVID, monetary and fiscal policy. It is a year very, very much full of events, full of volatility. We had a very dramatic ride, gone through a lot of serious issues, and at the end of the year that we had a huge relief with policies announcements and policymakers reconfirmation of their focus of the government's agenda, which all of that altogether leave us to, I think, me personally would have thought with a year like this, we probably would have a year that has our China Internet Fund, particularly the sector right at front and center of a lot of these issues impacted by macro fundamentals, investor sentiments, would have been at the best catch up with the rest of the global indices. But when we look at the returns of internet funds, internet sector, particularly the CSI Overseas China Internet Fund, that is the index of KWEB, that obviously we're pleasantly surprised, but I do admit 2022 is not a year for a very positive, very dramatic, good returns of risk assets overall anyhow. But on that basis, it proved a couple of things. One, the internet sector actually outperformed S&P, outperformed MCN, all country world, outperformed EM, outperformed Asia, ex-Japan, outperformed NASDAQ by 16%. Obviously, we could wish that is a better positive return, but relatively story, this is at least tell me for the lessons learned when I look back to 2022 is number one, China is a strategic asset allocation. Okay, it's not for tactical. You could have gone through a lot of volatility. I'm with you. I'm personally also invested in China. It's on this basis. It's not to be cute, to be time in and time out in China. Obviously, tactical opportunities can be interesting, presented where and how your portfolio is allocated and presented today. You could use that opportunity to manage your overall exposure. But the lessons for me, myself, learned is we got to have a piece in China. It's a strategic asset allocation overall. It has plays out to be, the reactions, the performance of this asset class can be quite quick. And second, this is down to the development we see in the last probably 2-3 months of last year, is policy can turn into favorable, into accommodative for this asset class, and policies does matter to this asset class. And then now we are confirming the Chinese policies can and tended to and always be its self-focused, its own domestic economy. That means the diversification benefit, the long-term owning this asset class to be uncorrelated to the rest of the asset class you own in your portfolio stays intact. So the diversification benefits of owning China still make the arguments, make the statement. So on that basis, it was a relatively a better year for KWEB. And then I would say that's better even than I would expect it. If you go to the next page, what Brandon and I was preparing and going through this deck when we want to come and present to you is there's a lot on our list, on Brandon's list, on my list, when we monitor China as an asset class, monitor China as a capital market. A lot has happened, a lot's going on. And then where we start to share with you, the audience today, is where we stand on China capital markets. And I think that's best to start with Brandon's and mine's combined checklist on China as a capital markets. So this is our holistic view of a checklist that we monitor on a very frequent basis. This is top 10. We probably have a few more, but let's just bear with us with these top 10. And if I may group them in the regulations, either the domestic or external, we're going to go through each of these items in a bit of a grouped categories, pages in the following page. But all I want to say is all these 10 items that is on frequently on our checklist, if this call was a year ago, a lot of them in the column status would be amber and red and a watch. Today, the status has changed dramatically different than a year ago. That is the good news. And Brandon and I will share more with you on what we have seen as a development, as a statement, as a progress over the last couple of months, lead us to believe our view in 2023. But on a very high level, the regulation side, particularly domestic impact internet sector, is now safely to assume the regulation introduction cycle is behind us. Now a lot of company has implemented, has rectified. Many of them have moved on to acquire different line of business, continue to build up and brand, expanding their business. So that's in my list, in Brandon's list, that impacted item has become a green status, means it's behind us, it's on the trajectory for the company to look at the fundamentals and grow net revenues. The external factors, ADR delistings, US and China regulations, I say now because of the latest statement announced by CEWC late December, if you follow Brandon's China Last Night blog, you will see that already. That has come across a very constructive tone from ICEC. They have confirmed themselves, there's no challenges, no issues, no hurdles for them to access the book, access the business, access the auditing needs as they needed. They came back with a satisfied results of their entire process. So again, that's a big risk, I think, for many of you who is in US, always hearing this in the media on the ADR delisting potentials. Now that risk has significantly reduced. The statement from the regulator become more positively toned than probably just a few months ago. Domestically in China, few developments that changed the tone from October, November time. In China was on the zero COVID on real estate, and some of them touched domestic policies. We'll touch base on what event happened in December. What was the message from those economic working group that led us to believe this? But all in all, our watch list now is more of like the external, the macro factor, the regulations factor is become more settled, more clear, and we were given more clarity at this juncture. That led us to feel more comfortable of the macro factor become more accommodative now than a year ago. And now is probably the time to look at the fundamentals. Hence, we want to see where the physical will be, where the employment number would be, where the accommodative policy will get introduced, and which sector will get benefited from it. So I'll just pause there because we're going through some of the details in a later page. Brendan.
Yeah, one of the key pieces that we wrote at the end of last year was a piece called "Back to Business." It was the post-party Congress pivot on the big three, and our thesis was that within China there was no policy adjustments due to the importance of the party Congress, which took place in October. That government officials, due to mandatory retirement ages and the potential promotion, that there was no significant changes in any policies leading up to the party Congress, because everyone in the Chinese government was so focused on ensuring that they have a job for the next 5 years. And immediately with the end of the party Congress in the end of October of last year, on the three significant issues that have weighed not just on China's economy, but on China consumer sentiment, on foreign investor sentiment, we've seen a significant 180 on these three big issues. And the first and foremost is zero COVID. That all of a sudden, dramatically, zero COVID, the chains have been thrown aside. And yes, certainly some of the protests, which obviously the government is attuned to what the people, their desires and their frustration with zero COVID played a serious effect in this coming aside. Now China is a very big city, very big country geographically, and elements of China are well off in terms of the level of healthcare infrastructure relative to, say, rural areas where healthcare infrastructure is quite low. So within China, you're going to see different geographical areas moving at different speeds on this. And we should be prepared for a Chinese city or province have to take some steps back. But it's very clear that Omicron is running rapid through China. Beijing is actually gone through peak, where Shanghai is still in a much more difficult situation. And to help you track this, within China last night.com, on a daily basis, we're providing on several major Chinese cities. We can't do it for all 130 Chinese cities that have more than 1 million people, but we actually provide the data, the real-time data on traffic conditions, which that comes from the GPS in people's phones as they're driving down the street in Beijing. We can know how bad the traffic is, as well as by the number of people who are using the subways in these major Chinese cities, as well as this heat map showing new confirmed cases. And again, you can see in southern China, as well as in kind of the coast mid-tier, you're seeing it's still a difficult situation, but other elements of the big country geographically are in a much better space. So again, another great reason to sign up for ChinaLastNight.com. But again, I think the key here is that you've seen zero COVID. The opening of China is happening. Certainly international flights now inbound and outbound, Hong Kong opening up, Macau opening up, and certainly zero COVID. Again, major steps forward. There'll be a step back or two. We're prepared for that. Now, on the next slide, we look at another significant issue that's really weighed on foreign investor sentiment, as well as consumer confidence in China, as well as on the Chinese economy. And that's real estate. Now, real estate is a twofold issue. The first is the distressed property developers, companies like Evergrande and Country Garden and Sunac, and there's a whole host of companies that fueled rapid growth through issuance of debt. And as the government realized that these property developers are highly levered, that they instituted these 3 red lines, and the 3 red lines applied liquidity, debt to equity, that created the issue starting about 2 years ago. It created Evergrande's problem. And we've seen that pendulum swing back in a fairly dramatic way, where the medicine for these property developers, the proverbial patient, the medicine almost killed the patient. And so you're seeing a backing away, and actually the government explicitly supporting these property developers. Now why that's important. So remember, if you saw an outright default, which we don't anticipate, it would have an effect on the more than 120 banks that have lent to these distressed property developers. It would affect the non-bank lenders, but it would also affect the investors, the people who have paid for an apartment that hasn't been built. They would lose that down payment. Think about the construction companies building these projects, the people running the cement mixer or the electricians and the plumbers. They need to get paid. And if you have an outright default, if you had this proverbial Lehman moment, then it would have this huge downstream effect in terms of the people who've paid for apartments, the people who are building these projects. So we don't believe that's going to happen. That yes, these companies will pay for their sins of the past, but that not in the short run, not an outright default. Very similar to how the ECB dealt with Greece. You extend the debt, you cut interest rates, and bondholders will take a haircut. But an outright default, we think, is highly unlikely because of this net effect. So that's certainly been another issue. This has been a significant headwind on investor sentiment, as well as consumer confidence in China, because you can see we actually saw a decline in Chinese property prices. Now how that affects consumer confidence is on the next slide. We highlight how a lot of Chinese urban household wealth has been invested in apartments. I know, Xiaolin, you've spoken about the experience of your father that, when you go to China, you don't say to someone, how much money do you have in the bank account? You say, how many apartments do you have? And it's literally how you ask how someone's rich in China, how many apartments do you have? And Xiaolin, your father has done quite well, like many people in China. CICC says 2/3 of urban household wealth is invested in housing. Goldman Sachs says it's about a third. Now you can imagine, as those property prices came down, it has an effect on urban households, because they say, oh my gosh, these apartments we own, they might not be worth as much as we thought. And so it's had an effect on consumption, on consumer confidence. Very similar to zero COVID. If we think about zero COVID, if you're afraid of being locked in your apartment or being quarantined, you hoard cash. You don't spend it. And I think, we've seen that play out where it's estimated that the amount of cash that consumers put into bank accounts instead of spending is actually the size of the United Kingdom's GDP. That if we actually look at the increase in deposits in China, we're talking about trillions of RMB, literally trillions and trillions and trillions of money that would have been consumed went into bank accounts. And that's what zero COVID, as well as the propping up, the rebalancing of real estate is to revive domestic consumption in China. Really, our number one takeaway is domestic consumption is the play in China for 2023, and part of why we're very constructive on internet plays, which act as the transmission engines for domestic consumption. Now, our post-party Congress policy pivot on the big three, zero COVID, real estate. The third is the U.S.-China political relationship, really China's standing globally. And I think there's been a lot of concerns about, Russia's invasion in Ukraine. Could that lead to an invasion of Taiwan? But the end reality is China's economy is highly geared to the West. Again, very little was done on U.S.-China relations prior to the Party Congress, but simply after the Party Congress, President Xi, President Biden, G20, Asia Pacific Economic, the APEC meetings in Bangkok, continued talks. The planning for Secretary of State Blinken to visit, it's rumored to take place after the Chinese New Year, potentially as soon as February. Secretary of State Blinken will visit China. Think about this. The U.S. ambassador to China hasn't even been in China for 12 months. The lack of dialogue and communication led to the fraying of this relationship. And now we have people getting on airplanes, sitting down, talking to one another. Highly recommend investors read China's ambassador to the United States. He just got promoted to the head of foreign ministry. His op-ed in the Washington Post, very conciliatory, very much an olive branch. And we think that certainly China's economy looks nothing like the Russian economy. China is highly intertwined in the global economy. And we love this piece on the lower right-hand side, which shows that part of the trade disagreement between the US and China has been that the Chinese government adds US manufactured goods and factories owned by US companies, and those goods being sold in China as part of trade. And if we simply add the revenue of US multinationals in China to the revenue, to the trade data, there is no trade deficit. And this situation is not unique to US multinationals. On the next slide, yes, we all know great companies are globally are doing great business in China. The Brookings Institute estimates that Chinese urban households spend $7 trillion annually. And US as well as global multinationals are deriving significant elements of their revenue in China. And in a lot of cases, it's not the companies people would guess. And we would argue that investors globally have a very high implicit exposure to China. And this is exactly why there needs to be greater dialogue between the US, China, as well as many global trading partners with China today, that our economies are highly intertwined, and simply saying that we're going to bring it all back, I mean, it would have such a significant effect on global portfolios. So we need to have greater understanding. So hopefully politicians getting on airplanes, they can take a page from, obviously trade, people in business are doing great business with one another as demonstrated here. Now, as we look back, as we look forward, I love this next slide, that if we think about many of the challenges, just obviously we had the US CPI print earlier this morning, but if we think about investors, if you're thinking about how do we allocate, well, many countries globally face very high inflation, and central banks will fight that inflation by hiking interest rates in 2023. And the end reality is that the situation in China is very differently. On the next slide, if we simply put our left hand up against the screen. So there's four big economic sectors that the World Bank looked at. And putting my hand against the left-hand side of my screen, you've got a country that in 2023, the World Bank estimates will grow at 4.3%. There's another major economic area that World Bank expects will grow 0.5. One won't grow at all, and one will grow 1%. And what's interesting is that country that's expected to grow at 4.3% has very low inflation. Actually released inflation this morning, 1.8%. It's expanding its money supply. Its central bank is not tightening, is actually easing, and valuations are pretty reasonable. Now look at some of these other economic areas. Moderate to no or low GDP growth, relatively high inflation, quantitative tightening. Central banks aren't just raising interest rates, they're bringing down their balance sheet, pulling system out of the financial system, creating a tighter, a less liquid. So just if you put your hand against the left-hand screen, where would you invest? Where would you invest? And I think that's a very key takeaway, is that if we simply took China out of the name for 2023, that is where you should be putting your chips. The question is, can you overcome the biases, the media, the scar tissue? Can you overcome it? And we would argue you have to take a data-driven approach. Now, Xiaolin, we've seen as we look at 2023, we talked about China is not raising rates. It's easing, that China is not tight quantitative tightening. They're quantitatively easing, that they're actually supporting the economy. And I know, the CEWC on the next slide, really important event. I don't think it really garnered the attention. So I think a dive in on this important event is certainly worthwhile, just to get people up to speed.
I couldn't agree more, Brendan. And I think what you have highlighted is a great summary from where we see technically and all these macro factors and geopolitical issues has been now resonated with, the external factors. And then one of the key domestic factors is where the policy stands. At the end of the day, it's a developing country. Policies matters the most in the country. In most of developing countries, policies matters. And this meeting, particularly worth highlighting, happened in December, held in Beijing between 15th to 16th of December. It's called Central Economic Working Conference. This is probably one of the 4 biggest developments we've seen in December. 2 of them are related to COVID, and then 2 of them are related to economics. And this meeting is first time ever. The new leadership, this Communist Party leadership, get re-elected in October. Now they first time ever meet together to set, like you and I have a to-do list. This is the government's to-do list for next year. And this is where they will set the target or give indications where the policy and everything will be put in place. What's the target? So it's very important. It's highly regarded by the investors to get indications, get guidance of Chinese economic or China's policymakers' focus. I think in these meetings, all the key takeaway, at least from our perspective, is 3 things. Number 1, Xi Jinping and all the leadership from different ministries has reconfirmed growing the country. It's back to the focus, is the target, is the front and center goal for the country to achieve. So if anyone says, oh, is growing China back again is the focus, or is anything else is on top of the agenda, now they have come out and said it loud and clear, growing the country, deliver the growth target is front and center. And then second thing I think you got to remember from here is they re-emphasize a couple of things, but that's one singular goal is, they reminded the audience, the investors, next year, well, this year, 2023, Chinese New Year is not happened, so they always call them next year. But 2023 is the year, marks the first year of this 20th CCP, happened in October, first year of Xi Jinping's 3rd term. And they really want to achieve the target that Xi Jinping has delivered in his work report, which is modernized society. What does that mean? Translated to the economic terms is China got to deliver 5.5 GDPs for the coming years for another decade. So that means the growth, the target is set, the intention is set, the target is set. And the third thing, which is most important for these meetings to take away, is who is going to drive that growth? They have repeatedly mentioned platform company. And for those of you who listen to Brendan's quarterly update, is the internet companies often referred as a platform company. What did they say in a statement from this working group is the platform company got to be at front and center in creating jobs, okay, and improve their global competitiveness. That's another 2 things implied in that. Internet regulation cycle is behind us. They have implemented, dusted down, and moved forward. Second, you got to create the jobs, which is solve my problem as a policymaker, as the young people are still at, the unemployment rates of quite high. So they want Alibaba, Tencent's JD, who is the platform economy that easily can be a host for a small merchant to start their business, get down to, earnings, incomes themselves, and get some jobs created. So that to me is the country is setting a great or ambitious growth target, would needed a lot of policy to stay accommodative. And now they have confirmed the internet companies will be the key drivers to deliver that target, as they have been 40% of China's GDP growth. And if you move to the next page, we can always say, okay, all right, so the performance of the internet company has been dramatically impacted by the regulation. Now you are telling me the regulation is behind us, not only ours, read it from the statement. The policymaker of China also came out, remember February last year, March, April, it came out quite a few rounds to say, confirmed, it's behind us. It took investors some time to believe that purely because regulation can last a period of time. Now they are keen to restore investors' sentiments, restores investors' confidence. In the meantime, okay, as the investors or as the policymakers made the clarity, made the communication more proactively communicating with our investors, the companies in the internet sector are continue to grow their business. Like you say, what do you mean by that, Xiaolin? Look at this page. This is the top 10 holdings in KWEB. We have this report that reporting the underlying companies in the KWEB fund of their quarterly revenues. That's called Internet Report every quarter. I believe you receive that. This is exactly the data from the latest report shows each of the purple bar is how the top 10 companies in the KWEB fund has been generating their revenue quarter over the quarter. Traditionally, historically, KWEB fund would trade along the line with the revenues generated by the top 10 companies, like the blue line indicated in the past. That relationship breaks when the regulations get hit into the places. The performance has gone down dramatically, disrespect to the strong fundamental earnings still produced by the company. You could, of course, argue when the regulations get introduced, some of the revenue get impacted to, corrected a little bit. They have been back on their feet to stabilizing their revenue and continue to stabilizing at that rent. If you ask us, what do we expect from here is that gap between that bottom blue line dots to go back to reflect on top of the revenue. So that's the gap for the KWEB fund to continue to return back to on top of trading in line with the revenues. And if you go to the next page, I just want to remind everyone, because we treat it as granted because we believe many of you follow us anyhow very closely. So every time we refer KWEB and you know what we're talking about, the fund is exactly captured and tracked the entire ecosystem in China modernization life cycle. So that could be an internet company like Alibaba, platform company offering merchants and trade on top of that. Could be a company that is offering online healthcare services. Could be a company that is booking online tickets like C-Trip. Could be any company you could think of a modernized life that you would need all these companies utilizing them in the entire ecosystems. So Brandon touched base on this is a transfer engine to reflect the consumption power in China. So that's how KWEB structured to design to deliver. And we have this page here just for your reference, ease of reference. And then you say, great. If we go to the next page, the policy is set in stone to support the recovery of the consumption. Okay. And then the revenue was solid and sounding solid, but investors hasn't been looking at that. Our belief is 2023 is the year that the policy that drive the most of the correction in the previous year has become settled and turning a bit of a green and brighter and set in stone to say, now I'm going to stay accommodative. The fundamental disparities between the performance and the fundamentals will catch up. Investors will start to look at the performance, look at the fundamentals revenue they generated and reflect them in the performance. It has been doing pretty well in November, in December time, as the fund returned, outperformed the other indices, like I showed you earlier, the first page. What else is the catalyst? We believe this rally can continue and still have a long way to catch. One is the fundamental I touched base on. The other things is the huge underweight by most of the global mandate manager. And this page that, Brandon and I always keep a close eye on how and where they allocate. This is a different mandate, either a US manager, non-US manager, but it's global equity or Asia ex-Japan, you name it, different regional active managers. Where is their allocation today per China allocation. This has become very painful for the active managers because the majority of them, if not all of them, are underweight to China versus their benchmark. The rally over the last couple of months has led them to become a very painful trade on it anyhow. Brendan, if you have anything to add, just feel free to jump in. But one last point I want to make is when the active manager do the attribution report, they will see China Internet that they hugely underweighted has been hurting their performance, particularly the relative performance. As a result, they would have to, rebalance to a certain extent to today, given the clarities it's been offering and given by the Chinese policymaker. Second, the determination of the country is start to reopen. And as a consequence, you're going to see accommodative policy into the economy, the recovery of the consumption. We do think now China's economy is a slightly different cycle. What do I mean by that? Last year is probably going at the consolidation going down, and now it's stabilizing in the middle of the year towards the middle to the second half of the year. It's really stabilizing, and then you see it uptake. This kind of cycle is not about what not to own to China, it's about what to own in China, okay? And lessons learned from 2022 is you need to have some allocations to China. It's not a tactical, you need to have some allocation to China. Obviously, you can tactically allocate it, but the most important is this cycle is taking off. You got to pick the sector that is going to be accommodative or become more favorable to the policy support by the Chinese policymakers, and it's not crowded, and it's not reflective of the fundamental strong growth in this sector just yet. So I just conclude that there and let Brendan finish the rest of the deck.
Yeah, I think, Xiaolin, it's interesting that, even today, one of our institutional brokers, made the comment that they're not seeing a lot of these long only managers coming back into these names, that there's a lot of this skepticism due to a rough, 2021 and 2022. And I think that's why the pain trade is higher, that this underweight represents cash on the sidelines that can come back into the space. And it's not just the absolute performance of Chinese equities, particularly Chinese internet stocks. On a relative basis, India has underperformed pretty dramatically. I mean, today, for example, the Indian stocks were down, and the Shanghai, Shenzhen, and Hang Seng were up. Some of the internet names were a bit off in Hong Kong, as well as here, the US ADR is off a bit, but net China outperformed India. And that is part of the pain, that this tracking error quickly becomes negative alpha. And that's how you get fired. If you're an active manager and you're underperforming your benchmark significantly, you're going to get a lot of pressure. And again, I think this scar tissue, this hesitancy to come back in, is what will fuel further gains. There'll be corrections, there'll be pullbacks, but again, we're very constructive, particularly on the internet space. And I think the other thing, that jumps out to us is the disparity between US domiciled funds and their global equivalents. And that's where, just yesterday, on financial media, you had two China bears on TV, and there's, again, I think that just shows the level of skepticism and why, again, we can go higher. Now, I think the other takeaway is that this underweight is part of what created the underperformance that we had seen in 2021 and 2022 up until the party Congress. On the next slide, that if you think about these, the past slide showed institutional, actively managed funds in the global AJX Japan and EM category, that they were underweight China. And that lack of institutional support, we believe, allowed short sellers to push these stocks down, knowing that there was this lack of institutional support, particularly around the delisting risk, that, as a professional investor, are you going to buy a stock that could get delisted? Probably, I'd say no. And so if you have this vacuum, this lack of institutional support for the stocks, short sellers can hammer those stocks down. And by looking at the within the Hong Kong Stock Exchange, the main board, so these are the big names, much higher listing requirements. Short selling activity in 2022 increased 64% versus the 10-year average. So short selling average from 2011 to 2021, it averaged about 11% of total turnover was short turnover. And in 2022, it jumped to 18%. More dramatic is over that 10-year period from 2011 to 2021, there were 2 days when short selling turnover accounted for 20% or more of total turnover. And in 2022, there were 46 days where short turnover was 20% or more in 2022. Just incredible. I mean, these are all, this is beyond a 3 standard deviation event. And what's interesting is in this rally, short sellers have really backed off. And again, I think even on a choppy day like we had today, it's interesting that, the Hang Seng went from positive to negative twice. And again, I think, you're going to see a lot of investors be forced to buy dips as they take place. And, I know, Xiaolin, another interesting anecdote on the next slide is Southbound Stock Connect.
This one I can speak on behalf of the people I know, because, we use this as an example in many ways when these big names that listed abroad, that Chinese domestic investors would have no way, very limited access to the stocks anyhow, because of the capital control, because it's hard to open an account in US and so on and so forth, mainland investors, so they couldn't possibly invest. And Tencent is one example, Alibaba is another. And then you touch base on the real estate slides early on, Brendan. One thing worth noting is real estate is 60% of financial assets. That's only going, smaller and smaller if you look back to history. But where else can they invest? The Chinese people tend to invest in somewhere tangible, something they understand, something they know. They're investing in something that they have a feel about it. Obviously if not invest in real estate, they obviously accumulate up savings. The savings definitely go higher, or they buy some gold. But ultimately, is they buy something they know, they buy something they use. Like during the pandemic period, both Tencent, Ali, and all these companies has benefited from gaining market shares in tier 2, tier 3 cities in China. A customer group, they would never expect in the normal circumstances would leverage their services. Like, people like my dad, he's very famous now. He is using the traditional market pre-pandemic. He's go there to see his friends to buy groceries, but now he has to use the online services. And guess what? Because it's a good service, because it's the extra mile all this company has gone through to provide the additional VIP services, he would never switch back. And if now you say, Daddy, do you want to buy the company of Pinduoduo? Do you want to buy the company of Alibaba and then Tencent, the one that you use and now it's available on Hong Kong, potentially become Connect stocks? He would be more willing to understand that. So in Chinese, we have a say that you have a challenge, you have a difficulties in facing something, but you may have been forced to do something different, but you never know, maybe there's another window open for you. This is exactly the case when ADR delisting become a talk. A lot of the company are planning plan B to say, I will list back in Hong Kong as a secondary, or potentially I change that to become a primary, one way or the other. Now they opened up the door of millions of investors, mainland, would buy into their stocks. Obviously, we use Tencent as an example here to say, this is the mainland investors that are investing in Tencent, which is listed on Hong Kong today. This is just one example. We just want to show now, the company may chose a secondary or may close US listing and come back to Hong Kong one way or the other, they are not losing investor base. In fact, they were, get another door opened. Now they probably welcome another expanded investor shareholder base. Now it's in mainland, which I believe is going to be massive because the consolidation in real estate, household investors individually are now looking more options to the names that they know, to the names are very dearly to their daily life. And those are names that they use on a daily basis as a service.
Yeah, just incredible that, as obviously, KWeb, struggled, in 2021 and the first 3 quarters of 2022, this buying the dip from investors, they never believed these companies were going away, and they kept buying, and certainly they've been rewarded for that recently. It's and so we, definitely this is part of the re-rating that we could see in KWeb. I think, we've always recommended that, this offshore Hong Kong US ADRs, mainly what foreigners think about China. And we can then contrast that with KBA, KA50, which provides exposure into mainland China, which is 95% owned by investors in China.
Yeah.
And I think on the next slide, we show that one of the challenges that a lot of global markets will face because of not just the tightening, this fight of inflation, it's made bonds much more appealing relative to stocks. That, and again, in China, we saw the effect that, consumers worried about real estate prices, worried about zero COVID, hoarded cash, and that is being unleashed. And if you think about what's going to happen in many markets globally, consumer sentiment will decline. This constant barrage of talk about recessions becomes somewhat self-fulfilling, and stock markets are for excess savings. And so I think it's another argument of, as China consumers, people have more confidence, they're more apt to come back into risk assets. And for mainland China, we actually show here, it's basically, the dividend yield of stocks versus the yield on the 10-year treasury. And you can see at extremes, it's been a pretty remarkably strong market timing. It's a very simplistic market timing tool. And certainly, our model business, we've developed much more sophisticated timing type strategies. But this is such a strong argument for why, we want some exposure to the KBA stocks, the KA50 stocks, because mainland consumers are going to come back into, we believe, into mainland stocks in 2023, as well as part of foreign investors have been allocating to this Shanghai, Shenzhen, this mainland market, the stocks held by KBA and KA50. And we can track that on the next slide on Northbound Stock Connect, that just as Xiaolin spoke about mainland investors getting access to Hong Kong stocks via southbound, it works in reverse. And we can track Northbound Stock Connect flows. And so this is buys net of sells. So this is the net inflow. And just today, 1.4 billion of net of buying went into the stocks we hold into KBA and KA50. And I think, it's been a very strong start to the year in terms of the foreign flow. And again, part of why we want to hold both this onshore versus offshore market, KWeb as well as KBA or KA50. On the next slide, just because we want to leave some time for Q&A. Again, post-party Congress, we've seen the pivot on the big 3: zero COVID, real estate, US-China political relations. Because of skepticism, the scar tissue, the constant negative media barrage, we think the pain trade is higher. And there's a lot of data, as we showed, that shows a lot of investors are on the sidelines. And markets will do what's least expected, which is higher. There will be corrections, there will be pullbacks, but we think those provide opportunities for investors to re-weight China. And in particular, we believe that there's a big opportunity in China on an absolute and relative basis. And again, Xiaolin, we just released our 2023 outlook. And on the next slide,
we just, obviously Brendan says, reach out to us. And then in our outlook also, often Brendan and I get asked is what is our pick? What is our preferences? I think I highlighted a little bit to you early on. Lessons learned and also looking forward is really to have a core strategic allocation to China is important. We recognize the volatility, we recognize the returns as a such and relative performance as a such, but this is at the juncture that the overall sentiments is become, recovering from the very low level. We recognize that, but overall the policies, physical, monetary, and corporate, policies will stay very accommodative. In those instances, opportunistically holding some positions that can take off and lead from the China capital markets recovery, also important. In those instances, we do think from the grainer perspective, holding or investing into China, getting a yield in China, particularly those are good corporate, but get capped by the overall ratings in the real estate market's impact is very important. Getting a lot of good yields from the KHYB fund, and then obviously KBAB and A50 as a core allocation to the thesis. I say satellite is other things you got to have a vision and have a look into. Is China really determined to achieve this carbon goal? So either their own companies leading in the clean technology perspective or make a huge contribution to the global electrical vehicle and future mobilities, like the cars fund would be important. And Star Fund obviously is the semiconductor that China is really very keen to become very strong in those positions. So we pick some opportunistic and satellite allocations. We think it makes perfect sense with the core allocations settled around for those sectors also to lead out of the recovery.
100%. And yeah, I think, KHYB, which is listed here in the United States, we can get through to some questions. We got to go through some regulatory and compliance slides. But I think KHYB is very interesting because historically, that market had a very, the US dollar high yield bond market in Asia was really dominated by not just Chinese companies issuing, but also in particular these distressed real estate developers. And my background in over 20 years in kind of the passive or indexing space has been when you see an individual sector or stock or country become such a disproportionate percentage of an index, that's usually ringing the bell at the top. And Chinese real estate developers became almost 50, China was almost 50% of this offshore dollar bond market, this US dollar high yield. And that market has just been really, really decimated. And because those real estate bonds came down so much, and now you're seeing all this policy support to support the companies. If anything, a lot that might be negative for some of the real estate equities because the companies are being allowed to issue more stock, which obviously bolsters their balance sheet, but actually really helps us as bondholders. And I think we're getting almost a 10% yield. And I just think that KHYB is a very interesting ETF listed here in the United States. And full disclosure, I am a shareholder. But let's dive into questions. I know it looks like we've got some a whole host of questions here. One question that I saw that our friend Chris asked was about the currency. We didn't really talk too much about the currency in hindsight, Xiaolin, but it's fascinating. I mean, again, we've always recommended to investors to watch the currency as a risk barometer. that when you see these headlines, stocks can move really easy. They can move based on headlines. The currency market is much, much bigger, deeper, and almost tells us whether or not should we be really concerned. And I think the versus the US dollar, we had another really strong move overnight. Renminbi appreciated to 674 versus the dollar. Renminbi is actually quoted differently. It's actually the numerator and denominator. So as the currency level comes down, because it's CNY divided by USD, this downward move is actually showing appreciation in renminbi versus the currency. Somewhat confusing at times, but we've seen a really strong renminbi versus the euro and the dollar, and certainly, I think another kind of contrarian sign, for investors. Not what you would think, right?
Yeah, I think but the yield appreciation, if it's stabilized, now is the time to reflect China's reopening, the pickup in exports, and particularly the pickup in activities. You probably see a bit more bullish on the currencies down the line in the near term. That's in return going to be supportive to our thesis in the equity market.
Mm-hmm. And certainly for those who, if you're able to download the PowerPoint via KraneShares.com, but certainly, please feel free to email us at info@KraneShares if you'd like to receive the PowerPoint via email. And again, those looking for continuing ed credits for CFP, SEMA, and CPD, just email ce@info@KraneShares. But any of the questions jumping out to you, to Xiaolin?
Just going through them. Thank you for a lot of the questions. COVID, again, we gotta ask this, I think you addressed them already on the COVID, if there's rollback infection cases increasing, the labor market kind of impact. Guess will that be a bit labor market impact? I think near term, yes. Would you agree, Brendan?
Yeah, I think something we've seen is people with the spread of COVID in China. You've had some stresses on some of the food delivery companies. Just the delivery people calling in sick. Certainly on you've seen various factories have shortages, but at the same time, there was talk from one of the leading healthcare officials in Shanghai saying that they felt 70 to 80% of the population had been infected with COVID. So again, different, such a big country geographically that, getting through peak COVID, that cycle will move at different paces, but that will have an impact on people, the unfortunate consequence. Some people, get sick, some don't. So I think it will have an intermediate, intermittent effect. Again, I think you should prepare yourself mentally for a, headline blaring red lights, China city goes back into quarantine or lockdown. Yeah, that's 100%. We got 2 steps forward, but we're going to have a step back. An individual city, might be overwhelmed. Its healthcare system might be overwhelmed. Is all 130 cities with more than 1 million people going to experience that? No, but that's not what the headline's going to say. If it bleeds, it leads, right? So yeah, I mean, I think it's almost part of this rally we've seen in KWeb, Xiaolin, that there'll be a correction, there'll be a pullback. Maybe that's happening today. But I think, again, very constructive on the long-term case for 2023, this re-rating.
Most of my family members in China are infected. They all test positive. The good news is they all recovered and recovering. None of them are in touch wood, any critical conditions. They live in Harbin, they live in Wuhan, have relatives that live in, in different places in Guangzhou. Have a few families there in Beijing. The unfortunate case is they all got infected. They all live in cities, by the way, but they all recovered, and some are lingering a bit and recovering. So that's good news. They got treatment. None of them are telling me they're not getting treatment. They got treatment. You could say you're quite fortunate to live in the city, but they do believe there are still a bit residual going on. But most of the people is on the recovery trajectory. So that's a good news. And then January, heavy loaded with Chinese New Year, national holidays. For those who is not familiar with the national holiday systems in China, is the entire country off at the same time. Like you and I can take our vacations anytime we like throughout the year. China is using a system that they have a national holiday, everyone off at the same time. 32% of national allowance holidays is in January. So a little bit of a holiday off, time period off, sick time off from labor. I think overall, Brandon, the economic impact of the activity would expect it to be low anyhow in January. So material impact would be manageable in January, I think.
Yep. And one question that jumps out to me is, was a question about, the reshoring, which, and I think that goes back to, there's a few points on this. One is just, as we showed, many global multinationals, Italian companies, companies in the United Kingdom, across Europe are doing great business in China. And many of those companies actually will manufacture goods in China that, where would you put a factory? Where there's 1.4 billion potential consumers, or where there's 400 million? As well as the China acting as a gateway to the broader 4 billion people in Asia. So an element of why these factories are in China is simply because that's where the clients are, the consumers. And people love to say, we're going to bring it all back. We're going to bring it back. Well, that is mathematically impossible. The labor force of the United States is 120 million. The number of Chinese employed in manufacturing is 100 million. Raise your hand if you or your children want to work in the US version of a Chinese factory. No, thank you. As well as there is a tremendous environmental consequence to the manufacturing that China does. You ever seen how rare earths are processed? It's terrible. And that's why, an element of the terrible pollution in places like India, like China, is because the developed world is so fortunate that others are willing to take that. And there is no appetite for the environmental consequence of this, bring it all back. I mean, it's funny, Taiwan Semi said that this Arizona plant, their margins, their cost to manufacture in the United States will be 50% higher than in Taiwan. And in fact, people in Taiwan are angry that Taiwan Semi is putting a factory in the United States. Like, you should be employing people here, not there. So yes, there are, for the automotive industry, for the military defense complex, having a chip plant in the United States makes a ton of sense. For a lot of the inputs to goods that are then, assembled elsewhere, it just makes, it is uneconomic to bring it back. And it's something that's just a real shame that, we're at full employment in the United States, and yet this bring it back narrative, it just is mathematically impossible. And it just doesn't make any sense, right? And again, those, a lot of these they're made in China, sold in China, but also distributed across Asia. It's just, to move it from China is so much more economical. But anything else jumping out to you, Xiaolin?
Do you want to give another maybe a brief summary takeaways on the ADRs, the SEC statement in December? I know we touched base on our earlier on a little briefly. And also you mentioned in your China Last Night blog. Maybe I saw a couple of questions asking what's the process, where we stand at, is that remove risk? What does it mean for investments? Maybe a bit high level, your take on how the audit went and what's the statement from the SEC on the experience they had.
Yeah. So back, in December, the Public Company Accounting Oversight Board, the PCAOB, said that all the companies had passed this initial audit review, which means it removes the delisting risk due to the Holding Foreign Companies Accountable Act. Again, this is an ongoing issue that, this audit review will happen, in perpetuity, that, the PCAOB does go out and they do great work. We're huge fans of their work. At the same time, the Chinese government changed the law that allows for this audit review to take place. So we think it's a great first start. And, again, the vast majority of the US listed Chinese companies are audited by the big four US accounting firms. And there'll be deficiencies, there'll be issues that the PCAOB will find. They do great work, and they fine audit firms all the time for tightening up their. So that will happen with Chinese companies over time. We should be prepared for it. But again, we do think that this is part of the pivot we've seen in terms of the post-party Congress. And so it's not surprising that we've seen a initial passing. I think there'll be examination of the VIE structure, and we'd recommend all investors to read our interview with the top lawyer in Hong Kong about the VIE structure. We should put that issue to bed, just as we put this audit review issue to bed. So it's a huge positive. And again, I think, Xiaolin, it's part of why we saw these professional investors sitting on the sidelines was, because of the potential delisting risk. And that passing, that should allow these companies to come back into the space. And I think that's a very significant catalyst for the space, as institutional investors coming back into these names, knowing that this audit review, we've had a passing grade due to the hard work of the PCAOB officials who spent quite a bit of time in Hong Kong. Very appreciative of their hard work.
And our investors, William Lawrence, is asking why there's so much resistance. William is not resistant. Is actually at the very beginning is against Chinese domestic law to open a state-owned entities to external auditors, because it's state-owned. It's against law. And the Chinese regulator worked very hard to extra mile to amend the law to allow them to do on-site auditing. So there is a process in place for them to have to change the current status law domestically in China to allow such practice to carry out. And they did that. That just shows the intention and willingness from China's side to get this done and move forward. The fact they weren't there in August, the fact they have moved forward from here, make ours and let us believe this is a constructive on both sides.
Yeah. And certainly, up until about 3 years ago, Xiaolin, neither France nor Belgium adhered to this. So, it certainly took a little time, but they are adhering, and that's, I think that's in general, some of the skepticism, some of the scar tissue, is why, we'd like, why you see some cash, some people slow to come back into the space. And, it's interesting, Xiaolin, this in today's China Last Night, in thinking about this, I wrote a little bit about, early in my financial career, we're going back several decades. I've worked for Salomon Brothers, and Salomon Brothers. There was a unit called Fibro, which back in the 90s was led by an incredible art, been named the best commodity trade ever, a gentleman by the name of Andrew Hall. And one of the great stories about Andrew Hall was he got interviewed for this big article about him and why he was so bearish on oil. And when the journalist went back to Andrew and said, hey, listen, I wrote this huge profile outlining your negative thesis on oil. I just want to make sure, I didn't, misquote you. And Hall came back and said, well, there's a problem. I'm now long oil. I'm not bearish. And it was, his ability to pivot, to do a 180, that, he was very negative on oil. And when he looked at the data and his analysis, he realized his thesis was wrong, but he didn't carry any emotional baggage. He didn't think about what the media was saying. He didn't think what the bears were saying. He took the data and he acted. And I think it's a great lesson for investors, when we think about, China in 2023, summon your inner Andrew Hall, pivot, pain trade is higher. Yes, there'll be corrections, there'll be pullbacks, but I just think we've got such a nice setup, and particularly on a relative basis. If you look at inflation, should we be cheering a decline of 0.1% month over month here in the US? Quantitative tightening, higher interest rates against the backdrop of higher valuations. It's just a very compelling market. But I know, I think we covered the vast majority of questions, Xiaolin, and certainly if you wake up tomorrow, have a question, please email us at info@KraneShares. Again, our full outlook piece is up on KraneShares.com now. Replay will be available for this webinar. If you'd like to receive the deck, info@KraneShares.com. And again, how to keep abreast of a fast-moving market, ChinaLastNight.com. So certainly appreciate the opportunity. Looking forward to meeting with investors in person in 2023 and beyond.
Thank you.